this morning or afternoon, wherever we are. Thank you for joining us for our exciting year-end tax update. I know a lot of you are accountants, so I know you're so excited about being here. I'm Dr. Susanne O'Callaghan, and I'll be your moderator for the next hour. I've been a professor at Pace University for 27 years. I specialize in auditing and internal controls. I'm also the co-founder of the Agnes McCarthy Charitable Foundation for Mental Illness. I'm the vice president of the Walker Institute of Executive Acceleration, and I'm a Gallup certified strengths coach. And today I have the pleasure of introducing two amazing tax professionals. So I'm really excited. First, though, let's do a few housekeeping issues. Michelle has muted everyone just to reduce the disruptions. This is also being recorded. And if you have any questions, please put them in the chat. Our presenters will try to get to some of the questions. I don't promise we'll get to all of them, but they will at least see your questions in there. So now it is my pleasure to introduce our two speakers for this afternoon. Kevin, I'll introduce you first. Kevin, raise your hand. Kevin Birdsall is a certified public accountant. He's been practicing in private practice for about 20 years. He received his bachelor's degree in accounting from the Lubin School of Business in Pleasantville. Yes. He has a master's degree from Fordham. He's pursuing another master's degree in taxation from Villanova University and has completed an estate planning certification from the Charles Widger, I think I sent that right, School of Law. Our second presenter is Kim. Kim, raise your hand. Kim Bourne is a certified public accountant and a certified financial planner. She's the founder of Playfair Planning Services. Kim holds security licenses 6, 63, and 7. She's a notary. She's a life and health CFP, an EA, a CEA, as well as being a CPA. She received her bachelor's degree in public accounting from the Lubin School of Business, Pace University in New York City. And so with that introduction, Kim, can I send it off to you? Would you like to begin by touching on some of the spending habits of the pandemic? I don't even want to listen to you because I've been spending way too much money. So go to it, Kim.
Thank you, Dr. Callahan. It's so nice to be with everyone today. There was an interesting article in Forbes entitled "The New Frugality," actually, how the pandemic has changed our spending habits. And I think that's a really great place to start. The article highlighted 3 things, actually. So certainly there is that urge to splurge, but we did find ourselves in a somewhat of a being very frugal when the fear of the pandemic set in and job loss and lots of uncertainty. So the article highlights actually 3 spending habits. One being the tendency to tighten our spending. So if you find yourself falling into that category of tightening spending, we thought it would be a good idea to kind of highlight this, think a little bit, perhaps a little bit more strategically about the areas that we might tighten and also what type of things you might do with the money that you have tightened up on. There has been a lot less dining out, more eating and working from home. And so additional savings can be available to invest and do other things to help to further us in terms of our financial goals. The lockdown, so to speak, that we found ourselves in can also lead to another habit, which is that urge to splurge. So as we hopefully find ourselves coming a bit out of the pandemic, we do find that we might go overboard in some areas. So I just want to kind of caution and be wary of that kind of life is too short mentality so that we're not spending unnecessarily. The third thing that we can do would be scrutinizing our expenses. The article also talked about that. Sometimes, we've just been so busy. The pandemic kind of forced a slowdown for us to think a little bit more seriously and look. Insurance is one of the areas that we might look at. Are our policies coordinated, or could we do business with one company, for example, holding our life insurance and maybe our auto and home insurance policies with the same company to get, gain different types of discounts. So I would encourage you, if you haven't already done so in terms of following these trends, scrutinize your expenses, look carefully at the different bills that you have, call up some of the companies, whether it's the cable companies and different things, to see what type of discounts you might be able to garner on a more permanent basis. I know personally, I have a plan for my office space in the city, and I was able to get a permanent discount on the monthly rate given the real estate situation. So there's always discounts out there. Sometimes if you don't ask, you don't get. So scrutinize those expenses, manage the urge to splurge, and tighten up where you can. Curious to see what our audience has been doing in terms of their spending habits and how they might align with the recent article published by Forbes. Maybe we can launch that poll and see where our folks are.
Okay, so Michelle has put up a poll with several choices. Which course will you follow?
The results are coming in.
They are coming in.
Well, it looks like we have some very wise folks out there that aren't succumbing to the urge to splurge, huh?
All right, I am going to end the poll and share the results. Kim, you want to talk about the results?
Yeah, sure, absolutely. So the majority of people are going to do a little bit of each, which I think that's good to have that balance. One of my favorite quotes is "everything in moderation, including moderation," Oscar Wilde. So it looks like other folks out there, 32% are going to do a little bit of everything. 29% scrutinizing expenses, always good to pay attention. No one is just going to blatantly succumb to the urge to splurge. 14% tightening their spending, and 25% are not doing anything. So I guess they're not allowing the pandemic to affect them. They're just kind of maybe sticking with their old routine.
Great. That was an interesting poll with interesting results, and some chat questions have come in because of that. Kevin, I think, is that poll still up there? Poll down? Kevin?
I took it down, it came back up. So
I saw it. Is it down now? I don't have it on my screen. Kevin?
Yeah, it's done.
Your turn. There's been a lot of changes that can impact our taxes. Do you want to touch upon the American Rescue Plan?
I do, and I think maybe before we do that, so we'll just give a real quick intro on the plan. There's been so many plans over the, really since the pandemic, happened, and probably for most of you, you're familiar or heard about the CARES Act. And we spent a lot of time. I was a presenter a year ago. We spent a lot of time talking about the CARES Act. So now this year, really, what the one that's impacting us from a 2021 perspective is the American Rescue Plan Act. That's the one that came out in mid-March of earlier this year. So we're just going to touch on high level some of the key things that came out of that. We can't get into too much detail, but I just want to kind of plant the seed for each of you, so you can say, oh, you know what, that impacts me. I'm going to need to understand a little bit more. That's really the objective of what I want you to leave the session with today. Before we do that and get into the details, we're going to launch another poll, and I just want to get a sense from the group of really your research and your knowledge from a tax perspective. So if you can just answer this, and this will help gauge us a little bit.
Okay, I would, and that.
Perfect.
Okay. Okay.
So not a surprise as I look at the results, you know, from this group and of course for, you know, for those alum that are Lumen grads, it's nice to see those that are, you know, they're researching at least to get an understanding. That's what I would hope that each of you, you know, especially I guess for those that say they leave it to the accountant to customize the strategy and plan. It's good for all of us to have that baseline, at least a general baseline of information. So I'm glad to see, you know, it's interesting. We also have a group that said, I only think about taxes when it comes time to. Over the last 18 to 20 months, we've been bombarded with so much and a lot of exceptional changes that have come to pass that are impacting all of us, whether we're retirees, whether we're students still in school, working, etc. So we've all been hit in so many different ways. So it's important for each of us to kind of have that base understanding. So I would say the cross-section of the profile of the results, I'm not at all surprised with. And we're now going to kick in with just some high-level thoughts of the American Rescue Act. So the first topic is going to be the recovery rebate. And for many of you, you may know that as the economic impact payment. So the last time we had that was right after the Rescue Act was approved in March. Typically, probably most in this group, if you were eligible, you received it, say, March, April, those payments. And each of us were eligible for up to $1,400, depending on income. And what they did is they changed the threshold in terms of, so full-time students were now included in that as well, and so forth. So one of the things to mention, similar to tax return filing for 2020, you'll have that opportunity if you know you are eligible and for whatever reason you did not receive the rebate, there's a recovery program as part of the 2021 tax filing. So it'll be looked at, you'll be able to substantiate either what you did receive, if it was based, because keep in mind, it's based on what your income was either from 2019 or 2020 at the time that those checks were issued. If your income is down in 21, you'll be eligible for even more up to that cap of 1,400. So recovery rebate, economic impact plan still in play for 2021. The other big one for those families out there with children, there's been a lot of changes with the child tax credit, a lot in this space. So in the past, and as we start to talk about some of these credits, there's a lot of intricacies associated with them, but I want you to take away certain of these credits are what's called refundable, meaning whatever you're eligible for, you could in essence get a refund depending on what the results of your tax return are. Versus in the past, some of these credits we're going to talk through were what's called non-refundable, that even if you were in an overpayment triggered by a credit, you would not get that extra. So the child tax credit has always typically been a refundable credit, but now it's basically fully refundable. So in other words, if you're eligible and depending on the rest of your tax results, you could in essence see the full amount coming through on the child tax credit. And really the key takeaways here are that it includes, so children that are up to 17 years old, so they bumped it up by 1 year. Normally it was under 17, and they also increased the amount. So now it's up to $3,000 per child. If you have children that are under 6, it's $3,600. And in the past, it was about $2,000. The kicker that I want to mention, and I think this is where a lot of us CPAs are going to be spending a lot of time this tax season, is the IRS thought they were doing a good thing. They were advancing folks money against this child tax credit. So starting mid-July, if you're eligible, based on prior year tax filings, you could have, depending on number of children, you could have seen up to $250, a mysterious $250 direct deposit into your bank, depending on children, or $300 if the child was under 6 years old. And they were advancing that monthly starting July, unless you turned the faucet off and said, I don't want to receive this. So that could jeopardize some that might not be eligible Now they've been receiving these advances, didn't know what it was. So I just want to caution everybody against that. That's exactly what that is. So you will see enhanced line items, some enhanced reporting now for the child tax credit. The other one, big changes on the earned income tax credit, and another tax credit. So really what's happening here is this is really for the low income earners that are out there with low, and exactly as the credit says, it's based on your earned income. So compensation, wages, those that are self-employed. And what they're doing here is they've kind of bumped up the thresholds that are available. So in the past, if you had investment income, you were limited to investment income, interest, dividends of $2,200. Now they've bumped that up and said a person, if they're eligible for the earned income tax credit, you could have investment income up to $10,000. Still fairly small income thresholds to be eligible for this, but just to kind of mention that that is out there. You can look back at 2019 or 2020 income levels when calculating the earned income tax credit. So just another one that's important. Another one with changes was the child independent care credit. So this is really for those folks that, you know, have little ones that either daycare, camp, before or after care types of things, where there's kind of one of two approaches. Either through your employer, you're using pre-tax dollars of your salary, and you're kind of tucking that away into a special savings spending account to use toward dependent care, or you can take advantage of the dependent care credit. And the dependent care credit is really what has seen the largest spike in increase. So now they're basically, from a credit perspective, you could have up to $8,000 worth of dependent care expenses, which honestly is not that much, given, you know, if you're in the tri-state area, that's not that much. So for a single child, you're up to $8,000. You could get a credit up to half of that, of 50%, up to about $4,000. Two or more children, up to $16,000, and about half is well, about $8,000. This credit also now is fully refundable. Like we were talking about different types of credits. This credit is now a refundable credit. In the past, it was not. So big benefit that's out there. Want to shift a little bit now to unemployment. You know, there were a lot of pre-questions that came in related to unemployment. So as many of you folks remember, this is the act that triggered that special credit that we all had against unemployment. So those that had unemployment in 2020 up to $10,200, from a federal perspective, that was basically exempt from taxation. Well, the fortunate news is it was in place for 2020. The unfortunate news is it's all bets are off in 2021. So those of you still on unemployment through this year, in particular through Labor Day, as the extensions, many of you may still be on continued unemployment, you will not be permitted to take and reduce for any threshold of unemployment. All of it will be taxable. Those New York residents, fully taxable in New York. New York didn't budge on it last year. New Jersey is exempt. So those of you New Jersey residents with unemployment, New Jersey does not tax your unemployment. And the last one, just to touch on for those with small businesses, and remembering the payroll protection plan that was out there, this act extended also having additional rounds of payroll protection plan funding. So we're nearing the end of that. That's winding down at this point. But this act brought a little more clarity. You know, many of us spent hours, countless days and hours of working with our business clients on payroll protection plan, and it really helped many. But at this point, most folks are really in a forgiveness, and it's winding down. So there really isn't that much. Just a couple other quick things now outside the Rescue Act, just to touch on very quickly, is hot topic relates to capital gains. Another lot of pre-questions came in this area. So as of right now, so when we talk about, you know, from a tax rate perspective, You have ordinary tax rates, which you and I are taxed on our income, we're taxed on interest, we're taxed on unemployment, you're taxed on for those retirees that are taking required minimum distributions from IRAs or taking distributions from 401ks. All of that's taxed at your ordinary income rates. So when you talk a tax bracket, the tax bracket is synonymous with ordinary tax rates. Well, there's another whole set of tax rates out there called preferential tax rates, which is where capital gains fall under. So for those of you that, have investments with dividends, have investments where you may have had some sales this year that triggered a gain on that sale. So as a result of that, these preferential rates, which are taxed at a slightly lower rate than ordinary tax rates, are either at a 0, 15, or 20. As of right now, there is no change to these rates, but lots of discussions are happening in Washington. It's anybody's guess what may or may not happen. They've already struck the income bands for 2022 based on a 0, 15, and 20% capital gains rates. Whether we'll see a change here, we don't know. But like I said, a lot of people are asking, should I sell off some investments? Is it better for me to take advantage of things this year? I'm very cautious and say, we know what we have today. We don't know what we're going to have tomorrow. So I'm advising my clients as we look at different things of really focusing on tax brackets they're in. And if we can take advantage and pull things forward to what we know we have now, that would, once again, everybody has their own individual situations, but that would be highly advisable to try to take advantage of as much in that space. For those that are telecommuting, just very quickly, not a lot has changed relative to what's called the Convenience of the Employer Act. So really, it doesn't matter where you're working, you're still going to be taxed where your employer is based. So if you're working for a New York City employer, as an example, working remote in Connecticut, New Jersey, what have you, you're still going to be taxed from a New York tax where the employer is based. So a lot of discussions and things happening there, but just to share. And the last topic is I've personally been getting from clients a lot of questions related to identity theft. And I just want to mention for those that might not be aware, you can actually get a secure PIN number from the IRS. It's under what's called the Identity Protection Personal Identification Program. The IRS offers that you can get a secure PIN. You would either include it as part of your filing. If you have a CPA or an accountant preparing it, you would give that PIN number and you are secure from a filing perspective. It blocks anyone from trying to do anything. Right now, the IRS has frozen accepting changes in this area or new applications until January. Highly advisable. Even if you're one that hasn't been a victim of identity theft, protect yourself. And you can check all of that out on the IRS website. It's worth writing it down. It's called Get an IP PIN Tool. I'll repeat that again. Get an IP PIN tool on the IRS website. Highly advisable. I'm advising all my clients. In the past, it was really for those that were a victim of identity theft that I was focusing on. Now I'm saying to just about everyone, get it. There's a lot of predators out there during the pandemic that have nothing better to focus on. All right.
Can we transition to Kim and then come back with other items?
Yep,
Great.
we've covered everything. I know
Great job.
Topics.
Great job. Kim, you want to talk about some other interesting tax topics?
Yeah, absolutely. I'll build on some of the credits that Kevin already shared, that we have some interesting changes into the tax credits. Again, dollar for dollar, these are things that reduce our tax liability, so they're much more advantageous than deductions. The lifetime learning credit, being an educational institution that pays, I'm sure that we're happy to know that that credit is being extended and not limited as much as in the past. By that I mean the income threshold. So the lifetime learning credit is a credit that's available for higher education, undergraduate, postgraduate studies, professional degrees, anything that's really designed to acquire new skills, new job skills. So there's a wide range of professional development that this credit can be applied for. In the past, however, after, as a single person, your income reached about $59,000 or married $118,000, the credit began to phase out. The good news is that the credit will not phase out now for people until their income as a single filer hits $80,000 and joint filers $160,000. So that's really good news. So that should mean that a wider range of people will benefit from receiving the full credit, which is $2,000. Staying online with education, student loan relief is on the way. Student loans typically, like most debt, when it is forgiven, the amount of forgiven debt was kind of recaptured as taxable income. That is not going to happen. It's only temporary though until throughout 2025, and then in 2026, we're going to go back to the old rules where forgiven student loan debt will be treated as income. Action item there, if you're able to restructure or go into some type of student loan debt forgiveness program, definitely get that on your calendar and make it a priority before the year 2025 so that you don't have the adverse tax consequence of having to then include the forgiven debt in income. The employer reimbursement, $52,050 cap on student loans, that is still available. So also make sure that you're benefiting from any employer programs for tuition reimbursement, student loan repayment, very important. So again, remember to refinance those student loans if you can, update your income for the student loan repayment plans. And if there's an opportunity for forbearance or student loan deferment, definitely make sure you're looking into those programs as they apply to your situation. Also wanted to just mention some deductions. So moving away from tax credits that reduce our tax liability dollar for dollar, there are some deductions which, while they're not as nice as credits, they do help us save on taxes because they reduce our taxable income from which then the tax rates are applied. So the first deduction would be the standard deduction. That is going to continue to get bumped up for inflation. So just looking at the rates here, they're started about $12,400 and then based on your filing status, they get bumped up. So you'll just continue to see the gradual threshold there increasing each year for inflation. Charitable deductions, as of our previous tax year, there is an above the line deduction was $300 only, and it was limited per return. So even if you were married, there was only one $300 deduction for charitable contributions that you could take even if you didn't itemize. Good news here is that amount is going to be doubled to $600 for married filers. So we're not limiting the $300 per return anymore. Now it's going to be per person. So make sure you have all of your charitable receipts. We know that since the standard deductions were increased under the Trump administration, a lot of people no longer were able to itemize based on that increase in the standard deduction and then the elimination of, or the limitation of state and local real estate taxes to $10,000. So a lot of people aren't able to itemize anymore. Our charities like Pace University and others are happy that we have this deduction where people who don't itemize can benefit from. So if you haven't already made your donation to PACE, this is a shameless plug to do that and get your above the line deduction, even if it's a small amount.
Good job, Kim. Good job.
I have to make sure we reach out to our fellow alumni and remind them about this one. But it's good. And I think it's a good, really important because a lot of charities, if obviously we give from our hearts, but we also want to get the benefit, the financial benefit. So definitely be mindful there. And then we have the medical deduction. So the medical deduction is actually, even for people who itemize, it has always been a challenge. The threshold there has bumped back and forth between 10% of your income before you could deduct the first dollar of medical expenses. It was 7.5% for a very long time, then it went to 10. Now it has been permanently set at 7.5%, meaning after you spend this first dollar, after reaching that 7.5% of your adjusted gross income, only then can you deduct medical expenses. the vast majority of people that have medical insurance, that have a comprehensive medical insurance, probably won't be spending that amount on medical expenses, even though the threshold has been lowered. So I would also encourage everyone to pay close attention to your employer plans. If you have healthcare spending accounts, pre-tax accounts where you can defer money before taxes from your payroll into these types of accounts, that's the best way to go, because waiting to deduct medical expenses at tax time is most times not going to help you to get that benefit. So take advantage of your healthcare spending accounts through your employer. The lowering of the estate threshold, that is something that was a lot of talk during the election. But basically, things are going to remain as they are for now. It's something that we're going to continue to pay attention to. Right now, the rule is that we have about, for single taxpayers, 11 million, a little over 11 million or 11.2 is not going to be subject to any federal estate tax. And for married couples, it's almost close to $23 million. So the vast majority of people are not going to be subject to estate taxes. That's the rule that has been put in place. But that, as it is in place, is scheduled to expire on January 1st, 2026. And then we go back to the way things were before the new tax law, where the amounts are more in the $5 million range for a single taxpayer, like $5.5 million, and 11 million for married couples. So here's definitely something to pay close attention to between now and 2026. Just as Kevin had mentioned, we know what the rules are now as it relates to income. We don't know what the future holds. So now is a good time to be having conversations with your estate planning attorneys. If you do have a valuable estate, it's not that hard to get a high value in estate, especially in the New York area where real estate is increased in value. Pay close attention and see if there are opportunities for gifting strategies. If you think that you might be subject to a taxable estate in 2026, when the threshold goes back to more in the $5 to $10, $11 million range. And then finally, just remembering our required RMDs, our required minimum distributions, those distributions that we're required to take from retirement plans. The Secure Act increased the age from 70.5 for mandatory distributions to age 72. So that is something to be mindful of. And for those people who are eligible for your Roth IRAs, remember they have no required minimum distribution age. So if you're eligible for a Roth IRA, or if a backdoor Roth IRA strategy makes sense for you, if your income is too high to contribute to an IRA, those are conversations that you definitely want to be having with your tax advisors at this time of year, because once everyone gets busy and the year comes to an end and the tax returns are being crunched out, there's not a lot of time for planning and strategy. So hopefully within the different areas that Kevin and I touched on, there's something there for you, an actionable item for you to save on your taxes.
Thank you so much, Kim and Kevin. That was so much information. I'm sure most people are understanding the complexity of our tax laws. We have one last poll that I think Michelle is going to trigger. It's up on my screen. I hope you can see it.
Mm-hmm.
And maybe we can touch, Kevin can touch on the marriage penalty, because it's showing up there. I had a question about it and it's on the poll. Okay, we have 9 people who have signed in on the poll. I think we should end the poll. We only have 28 people in there, but I would end that poll. Okay, Michelle? Thank you. Here are the results. Kevin, you want to take the lead on this poll because the marriage penalty is in there?
Sure, absolutely. So just to share, because some that may be a new term when you hear marriage penalty, and really what that's referring to is as you look at kind of what Kim and I talked about, and you kind of bring everything together as a husband and wife, you may not be getting the full benefits that you had as a single person. And really some of those key trigger points are as you kind of bring everything together is obviously from an ordinary tax perspective. So looking at kind of those tax brackets first, when you look at the single tax rates versus what a married filing joint tax rates are, where the overlap comes into play and there's not as much of a benefit. So it's not double, if you will. So you have what the rates are as a single person. If you double that, that should pretty much be what the rates are for a married filing joint person. When you get to the top tax brackets, ordinary tax wide, into the 37% tax bracket, that's really what's impacted. So there isn't that doubling effect. That's just one basic thing for those of you that are in that high income tax bracket. And I start with that one first because that's kind of the theme that carries across other areas. So we talked about the preferential tax rates, the capital gains rate, same thing happens there. For those married folks that are in the 20% bracket, they're going to have a higher portion taxed if they're in the 20% bracket as opposed to they would at the 15%. So that's another large area of consideration. There's some additional income thresholds that come into play that I just want to mention. The first is a Medicare surtax. So specifically for a single person with wages and taxable income at $200,000, that's a single person that they would be hit with a surcharge of 0.9%. Well, a married couple, it's not double that. It's unfortunately $250,000. So that's another, in all of these types of things, we're calling penalties, meaning when you bring together a husband and wife's income together, you're paying more than you would as a single person. So that's another one. The earned income tax credit, which I spoke of earlier, the thresholds are lower for married folks. So you're gonna be, as opposed to being a single person, with one or several children. If depending on that income, when you bring it together, you're not going to get as much of a credit. That's another one worth mentioning. And then the other one, which came out some years ago under the Obama regime, was the net investment tax. And that's, that really originally funded the original Obamacare. That's a 3.8% tax that's added on based on your investment income and thresholds. Once again, that's another one that a married couple could see a hit on, of bringing things together. So really, some of the strategies just to consider quickly would be, husband and wife, if both working, if one salary is substantially less than the other, these are things to consider. If there is dependent care expenses and so forth that you're taking advantage of through your employer, you may want to go with the low wage earner for that. So there's lots of different strategies and things that should be considered if you kind of fall. And it's always good to scrutinize what you have. This may be the first time you're hearing of the marriage penalty concept. It's good to just kind of look at what you have and are things optimized as much as they can. I just want to touch real quick, because I did look through the chat while Kim was speaking, and there's repeated questions related to Medicare and those Medicare premiums. And they're saying, how does it relate to the required minimum distributions of an IRA? Actually, there is no correlation. There's somewhat of a distant correlation, but really for those that, because you'd be getting your letters now relative to what your Medicare rates are. And what that means is they look at the previous year, so your 2020 filed tax return, what's called the modified adjusted gross income. Very close for many of you, it would be the same as your adjusted gross income on your tax filing. They look at that. So for a single person, for you to be charged, so when they look at your modified adjusted gross income, it would include your required minimum distributions, but it includes all your other income sources as well. So the other thing, so in terms of looking at what the Medicare premium rates are for a single person, you'd be at the flat standard Medicare premium if your income is $88,000. Married couple, double it, $176,000. So if you're within those income bands, you're going to be charged the standard Medicare premium. And then it goes up from there with surcharges. So that's basically how that works. So it's not only looking at your RMD. And the only other thing I saw in the chat worthy of this mentioning is there's a bill in Washington right now called the Build Back Better bill. And that has, so relative to the SALT limitation of $10,000, in that bill right now, it would increase the threshold to 80,000. Whether that'll come off the ground, who knows? But I just, a few folks were asking about that SALT limitation of 10,000. So there's a big push to see if that can be, we can get ourselves, at least for the tri-state area, for those of us in the New York, New Jersey area, to get ourselves into a more palatable space to utilize a little bit more. And I will stop talking.
Great. Thank you so much, Kevin. Kim, I'm throwing this out from left field. Julie had a question in there about using the home office during the pandemic. And I think lots of people are weighing in on it. I think there's a lot of controversy about that, taking expenses for a home office, which you might not have done prior to the pandemic, and given where we are right now.
Yeah, no, it's a challenge. I think, Kevin, you touched upon the challenges of home office with the situation that we have with the limited the change in things that we can deduct and itemize for. I think that's where that challenge comes in. In the past, we could claim employee-related business expenses, but that entire deduction went away, just like the deduction for tax preparation and different things on your federal tax return. So right now on your federal return, pretty much the deduction that people that work from home can claim are those people who may be doing business from home that claim business use of home. I don't know if Kevin, if you have any other thoughts on the working from home situation and expenses of maintaining a home office.
Yeah, it's a challenge because unless you're self-employed and you get the full benefit of it, for those that are, in an employee-employer scenario, they've taken that away. Back in late 2017, the Tax Cuts and Jobs Act eliminated, there was so much abuse in this space of really non-reimbursed business expenses. All of that's been eliminated. So it's very much of a challenge. All I can say is, for those of you that are in the employee-employer scenario, shoot to have as much of your much reimbursement from your employer. That's really be in that space, because that's unfortunately all you can take advantage of. If you have a small business on the side that you're starting, yes, then you could take advantage of home office, but it's a challenge if you're an employee of an employer.
Thank you. Michelle, I don't know if you have some questions you want to bring to the table, or whether we should have Kevin and Kim talk about what they think the future is going to roll out for us in 2022, 2023.
We do have a few other questions in the chat if you want me to address
I just saw,
those.
I think I saw that was a good one that came in there, Michelle and Susanne, about the donating of appreciated stock for charitable contributions. That's a good question and definitely a great strategy.
So let me repeat the question, Kim. Could you comment on the advantage of donating appreciated stock versus writing a check for charity?
Yeah, absolutely. Absolutely. So donating the appreciated stock avoids you from paying the capital gain upon the sale of, selling that stock and then writing a check. So definitely always appreciated assets make beautiful contributions for charities, and you get to deduct for the most part, the fair market value of the appreciated asset. There are other limitations depending upon the type of charity you might give to, in terms of your income limitation on the deduction. But unless we're talking about, very large donations, for the most part, you'll benefit significantly. And even if you do have some type of income threshold, you can carry forward the value of that appreciated stock to future years if you bump up on an income limitation. So great strategy to donate appreciated stock. Also a great strategy to donate if you're at an age where you can benefit from donating from your retirement plan directly, as opposed to writing a check. So there are good opportunities. Again, different people, different age brackets, different scenarios, different stock, different bases, a lot of depend upon this and depend upon that. So speak to your tax advisor and consider what bucket is best suitable to donate to PACE or other charities.
There was a
Michelle?
question.
Yep.
Yeah,
Go
there
ahead.
was a question earlier on about someone who's beginning an entrepreneurial venture, shifting from SP to S Corp. Is there anyone in the chat that would be available to discuss the best routes and potential potholes? That might be too large a topic, but maybe there's some resources that you could direct this participant towards.
SP stands for sole proprietor versus S Corp. So it's
Thank you.
it's a little bit beyond, it would be a little bit beyond the scope of this, just to get into kind of the basics. But an S Corp is a flow through entity. So it does file its own tax return. There are certain things you definitely need to be aware of. There's strategies. There's, the key thing that I would say, if you are starting out, make sure you're considering or you research the reasonable compensation concept related to S Corps. Super, super important. If you're not considering that right out of the gate, it could really put you in a spotlight with the different taxing authorities. So that would be just early discussion to look into that.
Mm-hmm.
That's
And we have
great. Go ahead.
Another question, how can gains tax, oh, it just disappeared, sorry. How can, where did it go? Sorry, my chat box shifted while I was reading the question.
No worries, Michelle. While you find it, there was a comment in there about donor advised funds. I just wanted to I'd also plug donor advised funds, a great year-end strategy, especially if you have a lot of income this year, you want to take advantage of what Kevin said and put additional income into this year, because we know what's happening now. We don't know what the future holds. You might also want to make a big charitable donation this year to offset some of that income, but maybe you're not clear on what charities you want to dole that out to. So a donor advised fund is a great opportunity to make a large charitable contribution this year, and then you can name the charitable beneficiaries in later years. So absolutely plugging donor advised funds for those benefits.
And just another charity for those that are taking required minimum distributions from the IRA, another concept or another acronym out there is called the Qualified Charitable Distribution, QCD. Really hot. If you haven't taken your RMD yet for this year, you have obviously 30 days left after today. Consider looking into a qualified charitable distribution. You can reduce your RMD. You can actually, work, through the financial institution where the IRA is. You can shave off the top monies to go directly to the charity. You can't cash in the distribution to come to you and then turn around and write a check to the charity. That would work just like your charitable contribution limits today. But you can actually have, before you pull the trigger on the distribution, have a portion of it go directly to the charity and the balance to you. And now you've reduced your required minimum distribution, the portion that's taxable. So real good strategy. I've been pushing, I have a number of clients each year, more and more are kind of jumping on in that space. So just highly advisable to look into that if you haven't done your RMDs yet.
And since Michelle Camardella and I work in PACE's Office of Development and Alumni Relations, I'll just put in a plug. If anybody's interested in donating to PACE, they can contact Michelle or me. Thank you.
And I found my question, it's back. How can gains tax be reduced on the sale of a rental property?
How can the capital gains tax be reduced on the sale of a rental property?
Yeah, the question says, how can gains tax be reduced on the sale of a rental property?
I would say the first thing is just to make sure that you track basis. Tax, that, that word basis gets thrown around a lot in the tax world, and that's the baseline for what the property is going to be, from where the gain is going to be calculated from. And sometimes we can just not keep the best records in terms of all of the improvements that have been made to the property over the course of the years. And that's not just a rental property, even at one's primary residence. So I would say make sure that you track everything that you would have invested in that property over the years to make sure that your basis is high enough. There is a 1031 exchange option, but that's not really a sale. That's when you replace the rental property and purchase another rental property. There are investment opportunities where if you put the funds into a 1031 type fund, if you sell the rental property, you can defer taxes that way. It's it's obviously a restrictive investment because it has to be a type of real estate holding, but it certainly is a strategy if that's something that could be applicable to you.
And
To have other thoughts, Kim? Mhm.
So there was an update to that. The gains tax started out, the rental property started out as a partial inheritance. Inherited
Oh, okay.
between siblings, and then one sibling was bought out. So should that be taken into account?
Oh yeah, when it's an inherited property, that's a very nice deal. There may not be as much tax as one might think, because generally speaking, when you inherit property at the fair market value of that property on the date of death, or an alternate valuation date, which could be 6 months after. So generally speaking, when you inherit property, you're not going to be subject to an income tax on the sale of that property, because most of the appreciation probably happened during the deceased lifetime. So that should be a good thing.
We have another question about the maximum amount that can be contributed to an IRA, and what's the tax benefit?
It's going to all depend on if it's kind of a general question, because it depends if that person's an employee already contributing to an employer plan, if they're married with income. So there's a lot, unfortunately, there's a lot of different pieces, but I would say is if a person wants to contribute to an IRA, not even to get the deductibility, you can go up to 6,000, but it's kind of a loaded question because there's a lot of variables to consider with that.
Yep, 6,000 for people under 50, 7,000 if you're 50 or over. And as Kevin mentioned, most people can contribute, but there could be variables. And on the other side, if you don't have much income, if you only earn $3,000 for the year, then you're only able to contribute what you put in there. And then your filing status, if you file married separate, can also create some other hairy opportunities. But the general rule is $66,000 for those under 50, 7,000 for those 50 and over, and then make sure you're putting it in the right type, Roth versus traditional, or backdoor Roth.
Okay,
Go
ahead.
There was a question about where can someone get information on 1031 funds. I think if they go to the IRS website, they have amazing information on everything. It's very obtainable, reasonable, easy to read. So I would go to the IRS website.
And just for that person asking that question, a 1031 exchange, you're deferring the gain. You're not eliminating it, just as an FYI. So,
Right.
And one more question. QCD works for IRAs. Is there anything happening with 403Bs in that regard?
I mean, they're pretty much, these different retirement plans, 401k, 403b, they're actually IRS code sections. And they generally follow similar types of rules in terms of the funding requirements. Different employer plans may have different rules specific to that employer, but generally speaking, they follow the same rules. It's just that the IRS set up code sections for nonprofits, retirement employers, which are 403Bs, versus the private sectors, which are 401k plans. So generally speaking, you'll see similar guidelines.
There were a couple questions before the session about Roth conversion. So just to mention, for those of you employed in an employer plan, you may want to look and see if there's any what's called in-service rollover that you could actually, in other words, you could roll over part of the funds that already are there. You could, and then you could do Roth conversion. So real important, but you'd have to research with your employer to see if they have an in-service rollover, if the plan permits any in-service rollovers. But that would be a real good strategy to look into, depending on where you are. So.
Cam, do you want to give us a minute and a half, maybe, of your look into the future, what you think the most exciting things or troubling things might be? And then Kevin, maybe a minute and a half, and then we'll close our session.
Sure. It's always nice to have a lightning rod. Yeah, I think the estate tax is where most of a lot of the excitement will be in terms of that threshold. There's a big difference between 5 million, 5.5 million, and double that amount. So we're really talking about a lot of New Yorkers and other parts of the country being subject to something, a significant tax that you weren't. So definitely, we know what the rule is. We know for sure that's going to change. Make sure you have a good estate plan in place, and then one that addresses taxes.
Great. Kevin, you want to comment?
It was going to be exactly the same space, which is why I do a lot of estate work of really. So for me, it's the concern with the estate piece. If we go from the 11.7 million exemption down to 3-4 million, and the whole other concept of what's called step up in basis. So as Kim was mentioning earlier, when someone passes, they get that step up. There's talk of that step up in basis now being taxed on the deceased's final personal tax return. So real concerned and working closely with my clients of all ages to kind of strategize, being more charity minded, really trying to figure out kind of that family plan, being open with the family in terms of, so I feel like I'm turning more into a family counselor with just a lot of those discussions happening. So that's what really makes my space a lot more enjoyable of really trying to work, but the estate space to me is also really, to me, where the action is right now.
Those are absolutely amazing comments into the future. I think that everybody must have gotten a lot out of this hour, because I know that I did. I hate taxes. I don't mean I hate taxes. My husband does taxes, but I'm going to Kim and Kevin for all my tax questions in the future. So I hope everybody has gotten a lot out of the session. I want to thank Kim and Kevin, especially for being such wonderful alumni and wonderful tax professionals. You are great. I want to thank the PACE Alumni Relations Office too for sponsoring this series. You've done a great job. I want to thank everybody who's attended and has been participating in the chat and giving people advice and going back and forth, trying to help each other out. And that's what it's all about. So I just want to thank all of you for joining us. And I will close it out with that.
Thank you for moderating. Appreciate it. And your high energy was appreciated.